Many influencers will tell you they have the secret to get rich quick from investing. Most of these are scams. This has led many people to conclude that you cannot beat the stock market. However, what if I told you there is a way to beat the stock market and it's not a secret at all? In fact, these methods have been published in numerous scientific journals. The principles I'm about to share with you will not get you rich quickly, but they will get you very rich indeed if you consistently apply them. For reference, if you invest 50k right now and you get 10% returns, which is the annualized average of the stock market, roughly, in 30 years you will have about $900,000. That's very nice, and that's why you should invest. However, if you can invest with a 15% return, which is very realistic based on these methods I'm about to show you, those 50k become about 3 million. And if you can invest with a 20% return, which requires a good deal of skill, but is possible, Warren Buffett has done it for a long period of time, and I'm almost at 20% annualized returns myself, then that 50k becomes almost 12 million. This not-so-secret method of investing relies on the stock market. The stock market is the asset class that has historically produced the highest returns, rivaled only by some measures of real estate that require a great deal of skill, time, and effort. And the specific selection method to pick your stocks is largely summarized by what's called the Fama-French 5-factor model. Fama and French are both legendary researchers in the field of finance, and they have constructed this 5-factor model that captures the 5 most important factors to guide investment returns. All of these factors generate what's called alpha, producing market-beating returns over time. The first and foremost factor is called value, in line with the field of value investing. Value in academic circles is usually registered as something like price-to-book ratio. So it's the price you pay for the stock relative to what the company is worth in terms of its balance sheet on paper. Many other metrics of value like price-to-earnings ratio or enterprise value to EBITDA have been proposed, and they also perform very well. Basically, buying cheaper stocks typically results in larger returns. This can be thought of in large part as a risk premium. Cheap stocks are usually cheap for a certain reason. Maybe they have a lawsuit, maybe they have low growth prospects, maybe they're in a dying industry. There's usually some risk associated with them, and that is why the stock is cheap, and you get a premium for that risk. So if you buy cheap stocks, you get compensated for taking on this risk. However, while this is the academic explanation, very often stocks are cheap for no good reason. They're just cheap because they have fallen out of favor with the market. It's not a hot stock, people don't know about them, they don't have analyst coverage, or people simply cannot invest in these stocks because they're in the wrong region. Whatever the reason, empirically, buying cheaper stocks has typically led to higher returns. The second factor is called the size premium. Size itself is not really a factor that generates alpha. It does not produce market-beating returns. It is mostly that small stocks are typically cheaper, therefore correlating strongly with the value factor. If a stock has a market cap of 1 billion, it's simply not very interesting for Warren Buffett or very large asset managers because they cannot put enough money into it to really move the needle. It would be 0.01% of their portfolio. And often, small companies can be thought of as riskier, so there's also a risk premium to buying smaller companies because things can more easily go wrong. If you have a large supermarket chain, for example, that has operations in many different countries, then they can easily close some of their shops and rebalance. But if you have just one supermarket, then if that one supermarket is not doing so well, then it's a bigger risk. The third type of stocks that typically outperform the market are high-quality stocks. Quality in academic circles is best measured by profitability, such as gross profitability, the amount of gross profits a company makes relative to its total asset levels. You can also think of it in return on equity, return on assets. There are many other types of profitability metrics, and they can all work. Most research, though, has found that operating or gross level profitability metrics perform the best because they are the cleanest and the least variable. The profitability premium is hard to square with efficient market theory. Why would more profitable companies outperform the market? Of course, everybody wants to own high-quality companies that are very profitable. Why would you also get a premium for that? Well, in part, it may be that the market does not fully recognize their quality, but you can also think of profitability as the other side of value. Academic researcher Novi Marx is famous for thinking of profitability in this manner. Basically, you can think of value not just as cheapness, but as cheapness relative to how profitable the company is. This is also what many value-based practitioners do, like Warren Buffett. You don't just think of the price, you think of what the company is priced at relative to how much money the company can make. Things like price-to-earnings ratio inherently take this into account, and especially measures like enterprise value to EBITDA. The profitability premium also works particularly well for this reason with something more artificial like price to book, and less well with something like enterprise value to EBITDA, because enterprise value to EBITDA inherently already relates value to profitability. Whereas if you use something like price to book value, it works very well to add a profitability factor, because then you also have a measure of how much money the company actually makes, not just how much it's worth on paper in accounting metrics. The profitability premium has been particularly strong over the past 2 decades and is exemplified by the rise of the Magnificent Seven stocks, all highly profitable companies. The fourth selection criterion to select market-beating stocks is the investment factor. The investment factor finds that stocks that have very large increases in asset levels typically underperform the market. So you want companies that don't invest too aggressively. There are multiple reasons for this. Research has found that goodwill on the balance sheet, for example, typically correlates with negative alpha. What this means is that many companies are overly aggressive with their acquisitions. Many companies love to grow, even if it comes at the expense of shareholder returns. They love to grow revenue, they love to make acquisitions and make a bigger business, more power, but they don't think about return on investment from a shareholder perspective. And these investments and acquisitions show up on the balance sheet as large increases in asset levels, which we can see translates into poor stock returns. Large increases in asset levels can also be a bad sign if they are due to inventory buildup or cash hoarding. Cash hoarding means that the company is a poor capital allocator because they have cash lying on the balance sheet that they could be investing or returning to shareholders. Inventory buildup is also a bad sign. Let's say we have a company like Apple that makes iPhones and we see that all the iPhones are just piling up in their warehouses and nobody's buying them. That's obviously a bad sign for their future returns. If nobody's buying their products, they're not going to generate any cash. Last but strongest, we have the momentum factor. Again, very hard to reconcile with efficient market theory. Stocks that have performed well in the past typically perform well into the future as well. There is some trend following. Stocks with momentum that are on the rise typically keep rising for a bit longer, whereas stocks that are falling typically keep falling a bit longer. The primary explanation for this is that markets are simply not perfectly efficient, and information flow is delayed. Bad news tends to take some time to circulate. It may reach professional investors first, and then reach more retail investors later on, causing a delayed reaction to certain information. Momentum has strong asymmetric returns though, because by the time your taxi driver starts talking about what a great investment Tesla is, you're probably too late to the party, and the risk of the stock crashing is very high. This is arguably the case for the current Magnificent Seven stocks, although they've already had a bit of a correction this year. Despite this risk, momentum is the strongest of all of these factors. It generates the most market-beating returns. Stocks that have high momentum typically perform the best, even better than very cheap value stocks. However, momentum is also the most difficult factor to capitalize on. It has high trading costs, and it has very high tail risk. Like I said, it can be very risky to jump on a momentum bandwagon, especially when a stock is already overpriced. Investors often talk about picking up pennies in front of a steamroller or taking the stairs up only to go with the elevator down. If you've been taught that markets are perfectly efficient, and you believe that the wisdom of the crowd will at all times price all stocks exactly at the best estimate of their intrinsic value, then these factors may sound like heresy to you. However, you'll have to come to grips with the fact that numerous scientific publications over decades and decades of time in multiple different countries, across multiple different asset classes, have established that these factors are persistent and significant. In fact, these factors have been practiced by the likes of Warren Buffett and the Benjamin Graham type school of investors for decades as well. Value investors try to buy stocks that have a net present value of future cash flows that exceeds their current market price. In other words, they try to buy high-quality businesses that are trading below their intrinsic value. This is essentially the same as trying to buy value stocks with high quality. So quantitative finance has essentially simply caught up to the investment practices of the best investors in the world. In fact, scientific research has found that Warren Buffett's investment success is explained entirely by adhering to scientifically validated factor exposure. In other words, Warren Buffett and the likes of Benjamin Graham were some 50+ years ahead of the party. They simply came up with the methods that scientific research has later validated to be market outperforming methods. And there is no real distinction between what the best investors in the world do in practice and what quantitative finance research shows is the best way to invest. A professional stock picker might not invest in a stock because they see that the business is becoming less popular and is losing brand value. Someone with quantitative finance as a background might not invest in that same stock because they see inventory piling up on the balance sheet. And as a factor exposure, we see that there is an increase in assets and therefore the algorithm will not pick up on that stock. All methods, very different in approach, lead to the same outcome and the same behavior. They're simply different ways of implementation. When it really comes down to it, investing is stock picking. Yes, even if you are invested in a market-weighted index fund, you are picking stocks. You're choosing, in fact, to pick stocks based on the market's classification of their market cap. Similarly, if you invest in the S&P 500, You are choosing to invest, broadly speaking, in the largest 500 companies in the US market. So you are again typically structurally overweight large cap and growth stocks. In fact, for the S&P 500, there is a subjective component to it that is based on a committee that decides which stocks exactly go into the S&P 500. The closest thing to truly not picking stocks would be to have an equal weight portfolio of the entire market. However, nobody does this, because it's impossible. The assets under management of any ETF or professional that will do this will become too large to invest in all the small companies. So almost any ETF is structurally overweight large cap stocks, which is probably why the small cap premium continues to persist. So in effect, everyone's picking stocks. Some methods of picking the stocks are just better than others. Some are very convenient, like ETFs, and some are less convenient, like manually picking stocks. The manually picking stocks allows you more finesse in generating very high alpha because you can concentrate on these factors more aggressively. Whether you want to go with the manual route, try to be the next Warren Buffett to pick stocks that outperform the market, or whether you want to go with a quantitative finance route using algorithm, or whether you prefer to pick an ETF that does the stock picking for you, using these methods, that's up to you. And I hope this video helps you construct a portfolio that suits your investment needs. If you're interested in my exact investment method and more detail on exactly how to construct a portfolio based on your level of expertise and your goals, check out my personal development course. I go into investing for beginner, intermediate, and advanced levels. And if you like this type of evidence-based content to master your finances and your lifestyle, I'd be honored if you like and subscribe.